Liquidity and market structure are two of the most important concepts in trading. Now, when you combine them, you get a strategy that lines you up with institutional moves instead of being trapped by them. So, in this video, I'm going to show you exactly how trading liquidity plus structure can change the way you approach the charts. Now, liquidity in the Forex market basically refers to areas where a large number of orders are sitting. It could either be stop losses or pending orders. All right. Now, these are usually found above key highs and below key lows. Okay. Institutions target these zones to fill their big orders, which is why you often see sharp moves into these areas followed by a strong reaction. Now we can see that this is one of the areas where we're going to be having liquidity, right? Because this is an area of resistance where price is finding it hard to climb above, right? And we're going to have buy side liquidity around here because once a breakout occurs, the next thing for traders to do is to enter a buy trade. So we're going to be having buy side liquidity here. Now, do not be surprised if we have a breakout from this zone and then we have a sharp reversal back down. It is not an uncommon event in the Forex space. Okay, when smart money is doing their thing, you watch out for liquidity sweeps like that. Okay, so think about it. If big players need liquidity to execute large trades, they'll push price toward these areas, basically areas of resistance, areas of support, resistance if it is up, support if it is down, where you have at least two rejections. We already have something like that around here. As you can see, so we have an area of support around here, right? Okay, so the smart money will push price toward these areas, right, to get the volume that they need. Recognizing these liquidity pools means you can anticipate where price is likely to go before making its real move. Now, market structure is simply how price moves in waves, all right, creating higher highs and higher lows, that is in an uptrend, or lower highs and lower lows in a downtrend. In this particular context, we can see that we have an uptrend, right? You can see price has been trending upwards. So we have an uptrend around here, right? You can see the formation of higher highs and higher lows. Okay. So you can see this is a low, this is a high, there's a higher low, there's a higher high, and so on and so forth. Okay, so the formation of higher highs and higher lows, you have an uptrend. Formation of lower highs and lower lows, you have a down trend. Okay, by reading structure, you can tell if the market is bullish, bearish, or ranging. Of course, a ranging market is that in which the market is going sideways. Well, we have a ranging market, around the current price action. Okay, not exactly the current price action, but if you look closely, you will see that we actually had a ranging market around here, right? You can see we had a ranging market around here before a breakout occurred, right? And then we had price still climb back into the ranging zone. Okay, so one of the most powerful signals in structure is the break of structure, or BOS for short. When a previous high or low is broken, it often signals a shift in momentum. Okay, like what we can see happen here, this was a high, right? And you can see at this point it was broken. It often signals a shift in momentum, and you can see that price came, tested that zone, went back up, and so on, right? So combining this with liquidity information gives you a major trading advantage. Okay. Now here is the formula. First of all, you need to identify a key liquidity area which is above a recent swing high, like this. a recent swing high or below a recent swing low. You wait for price to sweep that liquidity. Do not enter yet. Then once the liquidity is taken, once price has broken above that level and has swept liquidity, that is if it's a high, or broken below that level and swept liquidity, that is if it is a low. Once that has happened, once that liquidity has been taken, you watch for a structural break in the opposite direction. This could be a BOS on a lower time frame that confirms the market is rejecting the liquidity grab and is ready to move. So if, for example, price sweeps above a swing high, let's assume that price sweeps above a swing high here and taking out the stop losses that sellers might have placed above this level, right? Then it quickly drops back below and breaks structure to the downside. Let's say after price has broken above this resistance, hits the seller's stop losses, then it came down back and then goes below this level, because once it drops below this level, we're going to have a break of structure, right? So it's drops back, breaks structure to the downside, then that is your setup. It shows that the liquidity grab is over and the market is now moving in the real direction. Okay, the real direction is going to be the downside, obviously, because the liquidity grab has already occurred at the upside. Okay, now a big mistake that traders make is entering too early during the liquidity grab, thinking that it is a breakout. Okay, that is the reason why once a breakout happens, not just jump into the trade, entering a buy trade if it's a bullish breakout, or entering into a sell trade if it's a bearish breakout, because it could be a fake out. So you need to get your confirmations right before you jump into the trade. All right. The key is patience. Wait for the liquidity sweep and then the structural confirmation before making a move. Also, remember that not every liquidity grab will lead to a reversal. Sometimes the sweep continues in the same direction. Okay, that is the reason why structure confirmation is crucial. It is very, very important, because there are some times that you might actually have a breakout and that breakout will be legit. Price will continue going in that direction. It's not all the time that you have a liquidity sweep and then a reversal. Okay, it's not all the time, right? Remember that not every liquidity grab will lead to a reversal. Sometimes the sweep will continue, so bear that in mind. That's why structure confirmation is crucial. Trading liquidity plus structure is about aligning yourself with the flow of the market. You are not predicting, okay? You are just reacting to clear, repeatable patterns that the smart money leaves behind. So if you found this breakdown useful, hit that like button, subscribe to the channel so you don't miss future videos that dive deep into these strategies. Also, drop a comment below with your thoughts or questions about using liquidity and structure together. Until next time, trade smart and stay disciplined. See you in the next video.